I'm the CEO of Responsible Alpha. It's nice to meet you today. Today we're going to talk about ESG integration. ESG integration requires foresight and action, which forms the basis of our business ethic and guides our research and analysis. Our proven track record has highlighted material ESG risks and opportunities to investors, corporations, and NGOs, supporting capital preservation and improving environmental, social, and governance outcomes. For example, we advised a large bank on its ESG policy that supported the bank in mitigating reputational risk it faced. We informed an asset manager to exit a multi-million-dollar position in a flooring company before its shares collapsed because it was importing illegally sourced timber. We privately informed the C-suite of a large corporation whose key supplier was violating national laws while it was engaged in illegal deforestation. We have many other examples like this. ESG integration is how Responsible Alpha supports companies and investors to begin their transition to low-carbon, sustainable, and equitable future by 2025. ESG is a set of standards, metrics, and criteria used to assess environmental, social, and governance performance of companies, securities, assets, and their facilities, for example, and supply chains. The data is summarized into criteria that inform stakeholder actions and approaches to engagement in financial institutions, lending, underwriting, and investment practices. Industry reports now that currently more than $35 trillion in global assets under management is employed an ESG lens. For us at Responsible Alpha, we assess over 6,000 publicly traded companies. This enables forecasting pathways for transition to low-carbon, sustainable, and equitable future. It supports addressing climate risks, physical and transition risks, and opportunities within time-bound stress-tested model. It helps in enhancing identification of opportunities, turning risks into opportunities, while decreasing capital costs. We also support growing risk-adjusted returns. So for us, ESG integration employs a process that assesses ESG and financial factors that are directly and indirectly measured that can be shown to impact company, security, asset, and supply chain financial statements. You look at a group of environmental factors that includes climate change and carbon emissions, air and water pollution, including nutrients, chemicals, aerosols, and ozone-depleting substances, biodiversity integrity and loss, deforestation and change in land use and agricultural patterns, energy efficiency, waste management, water scarcity, quality and quantity, and ocean acidification. For social metrics, we look at human rights, product safety, labor standards, data protection and privacy, discrimination prevention, customer satisfaction, employee engagement, community relations, and supply chain risks. Land tenure, property rights, and free, prior, and informed consent. For governance, we look at board composition, governance, and independence, fiduciary duty, including audit committee independence and financial accounting rigor, bribery, corruption, conflicts of interest, and whistleblower schemes, executive compensation, lobbying, and political contributions, supply chain governance, and asset-level governance. Our process focuses on measuring, managing, and monitoring financial material ESG factors that are assessed within an investment decision-making framework. This process has 6 stages. Stage 1, analysis, assessing and identifying all relevant financial and ESG information over a specific economic cycle. Stage 2, framing the process, which includes employing a discrete time horizon specific to the industry's economic cycle, the product life cycle, the timeliness and consistency of the data, and the maturity of the security, and the time horizon strategy of the investment decision. Stage 3, risk analysis, conducting industry standard scenario analysis of material issues within a risk and return lens. Stage 4, forecasting Responsible Alpha's ESG integration risk on a quarterly basis in the short term until 2025, midterm until 2035, and long term to 2050. Stage 5, looking at the ESG integration with impact and engagement lens. From this, we'll look at liquidity ratios, which includes current and quick ratios, turnover ratios, which includes accounts receivable and payable ratios, leverage ratios, performance ratios, which includes EBITDA, return on equity, profit margin ratios, and valuation ratios. Stage 6, we expect our clients to support sharing of best practices. Now, the process which we do this includes a wedding cake approach where you start with operational risk, go to reputational risk, liquidity risk, credit risk, market risk, legal and regulatory risk, business risk, and finally strategic risk. We apply this within a double materiality lens, as you can see on the screen. And currently we have over 15 clients employing our tools. And finally, the way we approach this statistically is we only look at material, financial, and ESG risks that are considered likely, 66 to 100%, or very likely, 90% to 100%, and extremely unlikely, 95 to 100%. Thank you very much. Have a wonderful day.